The White House is expected to hold high-level talks with South Korea as President Trump hints at potential tariff reductions on China, a signal that Washington may be seeking to dial down trade tensions. This strategic pivot marks a subtle but significant recalibration in U.S. trade posture. While previous rhetoric from the Trump administration emphasized economic aggression, the latest developments suggest an openness to negotiation, at least on the surface. The inclusion of South Korea in these high-level talks adds another layer of complexity. As a major U.S. ally and trading partner, Seoul's stance may influence Washington's calculus in the broader Indo-Pacific trade strategy. Reducing tariffs would represent a tactical de-escalation, potentially calming markets rattled by months of uncertainty. However, the absence of concrete concessions from China raises questions about whether this is a genuine shift or merely diplomatic posturing. Analysts caution that any tariff rollback without reciprocal commitments from Beijing could be seen as weakness, potentially undermining U.S. leverage in ongoing trade disputes. China has signaled a willingness to engage in trade negotiations, but with a firm caveat: it will not negotiate under continued U.S. pressure. This conditional stance reveals a deeper strategic calculation from Beijing. By appearing open to dialogue, China projects diplomatic maturity, but by rejecting talks under coercion, it reasserts sovereignty and leverage. For U.S. officials, this is a high-stakes standoff. The Trump administration's tactic of tariff-first diplomacy may have reached its limits, with Beijing making clear it won't be strong-armed into a deal. This raises concerns among global investors. If neither side backs down, the impasse could extend, further roiling markets, delaying supply chain normalization, and exacerbating inflationary pressures. The statement also plays to China's domestic audience, signaling strength and resistance against perceived Western coercion, a narrative Beijing is eager to amplify amid a broader geopolitical rivalry. President Trump has warned that additional tariffs could be imposed on other countries, possibly including China, within weeks, unless new trade agreements are secured. This announcement sends a clear message. The administration is ready to escalate the trade war beyond China, turning economic pressure into a global strategy. Such broad threats risk destabilizing U.S. relations with key allies and trade partners, especially as global supply chains remain fragile from previous disruptions. For businesses, this creates significant uncertainty. With no clear timeline or criteria for exemption, multinational firms face rising input costs and investment hesitancy. Economists warn that a broad-based tariff offensive could backfire, triggering retaliatory measures, slowing trade volume, and further isolating the U.S. from its traditional economic partners. According to the Wall Street Journal, the Trump administration is considering cutting tariffs on Chinese imports by half in an effort to ease trade tensions and signal a potential breakthrough. A 50% reduction would mark a substantial retreat from one of the administration's most hardline economic policies, potentially unlocking stalled negotiations between the two largest economies. The timing is critical. With markets jittery and inflation pressures mounting, the White House may be seeking to project flexibility without appearing weak. However, internal divisions remain. Hawks within the administration fear that scaling back tariffs without meaningful concessions could embolden Beijing and undermine U.S. leverage. Markets are watching closely. Any perceived softening could spark a relief rally, but if talks collapse again, volatility may return with greater intensity. Treasury Secretary Scott Bessent has firmly rejected claims that President Trump is unilaterally proposing to reduce tariffs on China. Bessent emphasized that any adjustments to tariff policy would be contingent upon reciprocal concessions from Beijing, not offered as unilateral gestures. The distinction is critical. Unilateral tariff relief could signal weakness and erode Washington's hard-won leverage in ongoing trade negotiations. Market analysts interpreted Besson's statement as an attempt to reassure domestic stakeholders that the administration remains committed to a hardline stance unless tangible gains are secured. Besson's intervention also hints at deeper internal divisions within Trump's economic team, as factions debate whether tactical flexibility or maximum pressure will yield a better deal. White House Press Secretary Caroline Leavitt claimed that President Trump's tariff strategy is working, even though China has yet to make any meaningful concessions. This declaration appears aimed more at maintaining domestic political optics than reflecting actual economic progress. With no visible signs of compromise from Beijing, the assertion of success raises eyebrows among analysts. The statement reinforces the administration's narrative that economic pressure alone can reshape global trade behavior, even in the absence of reciprocal gestures. However, critics argue that this messaging may be premature. Without measurable outcomes, such confidence could alienate investors and embolden rivals who view the US stance as bluff rather than leverage. Leavitt's defense signals the administration's need to justify the economic cost of tariffs amid mounting political pressure and weak polling on trade policy. A recent Fox News poll reveals a significant public backlash against President Trump's tariff strategy. Only 33% of voters support the plan, while 58% oppose it. These numbers present a political liability for the White House. Despite aggressive messaging that tariffs are strengthening the US economy, most Americans appear unconvinced. The polling gap may reflect growing consumer frustration with rising prices and economic uncertainty, outcomes that voters increasingly associate with the trade war. For a president seeking re-election, such disapproval could erode support in key swing states, particularly those dependent on international trade and export-driven jobs. Political strategists warn that unless the administration delivers tangible results soon, voter sentiment could harden, turning trade from an asset into a liability. More than a dozen Democratic-led states have filed lawsuits against the Trump administration, arguing that the president lacks constitutional authority to impose tariffs unilaterally. The legal challenge strikes at the core of executive power. While presidents can act swiftly on foreign policy, trade policy traditionally requires congressional oversight, particularly when it affects taxation and commerce. This confrontation underscores rising constitutional tensions in the US federal system, where states are increasingly challenging what they see as executive overreach on economic decisions. If courts side with the states, it could not only limit Trump's trade authority, but also redefine the balance of power between the White House and Congress on international economic policy. In the meantime, the lawsuit adds legal uncertainty to an already volatile trade environment, further rattling investors and complicating negotiations with foreign partners. Geopolitical tensions in Europe are escalating as Ukraine and its Western allies intensify opposition to Russia, particularly over the status of Crimea. While this conflict lies outside the scope of US tariff policy, it injects additional uncertainty into the global economic environment. Markets are highly sensitive to overlapping risks, especially when geopolitical instability coincides with trade volatility. Investors now face a dual-pronged threat: protectionist shifts from the US and potential energy disruptions or military escalation in Eastern Europe. For multinational firms, the ripple effects are real. Escalating tensions in Ukraine may pressure supply routes, investment flows, and regional economic confidence, all while Washington continues its tariff brinkmanship. The broader picture: global trade cannot be disentangled from geopolitics. As the US hardens its economic posture and Europe contends with Russian aggression, the international order grows more fragmented, complicating coordinated responses to economic shocks. Peter Navarro once promised 90 trade deals in 90 days, a bold projection that symbolized the Trump administration's aggressive approach to reshaping global commerce. But as the clock ticks down, that target is slipping out of reach. With only 11 weeks remaining, progress has stalled. Several negotiations remain incomplete, and few concrete agreements have been finalized. This lag undermines the credibility of US trade negotiators and raises doubts among allies and markets about the feasibility and seriousness of Trump's economic diplomacy. The delay also casts a shadow over the administration's broader trade strategy. Without tangible results, investor confidence could erode further, especially as uncertainty piles up from tariff threats and legal battles. Ultimately, the 90 deals in 90 days slogan now risks becoming a political liability rather than a symbol of ambition, especially if little progress is made by the next quarterly deadline. A Fox News survey reveals mounting public concern over the economic fallout from Trump's tariff policy. 72% of respondents report rising prices, 55% say the economy is weakening, and 44% believe jobs are being lost. These figures paint a troubling picture. Tariffs, once promoted as a tool for economic revival, are now being viewed by a majority of Americans as a direct driver of inflation and instability. For policymakers, the data signals rising political risk. The disconnect between the administration's narrative and lived economic realities could fuel voter backlash, particularly in battleground states. Economists warn that if these trends persist, consumer spending may contract, dragging down GDP and corporate earnings in the quarters ahead. Investors, too, are watching closely. Any perception that trade policy is exacerbating, not solving economic woes, could trigger further market volatility and downgrade sentiment. The S&P 500 has recorded its worst start under a US president since 1928, a chilling milestone that reflects deep market anxiety surrounding the current economic and trade outlook. For investors, this downturn signals more than short-term volatility. It points to declining confidence in policy direction, particularly amid escalating trade tensions and legal uncertainty. The historical comparison to 1928, a prelude to the Great Depression, underscores the seriousness of the decline, though the fundamentals today differ. Still, the psychological impact is profound. Analysts suggest that continued instability in White House trade messaging, combined with softening corporate earnings, could prolong the correction and deepen fears of recession. Ultimately, the market's poor performance has become both a barometer and a warning, measuring investor sentiment and amplifying pressure on policymakers to deliver results. The Trump administration has emphasized that its trade approach is flexible, with multiple scenarios under consideration. But despite these reassurances, China continues to reject negotiations conducted under threat. This diplomatic deadlock reveals a fundamental mismatch in expectations. Washington frames its strategy as dynamic and pragmatic, while Beijing sees it as coercive and disrespectful. The divergence has real consequences. Markets dislike ambiguity, and without a unified path forward, investors are left navigating mixed signals and growing uncertainty. China's refusal to engage under pressure also signals that its strategy now includes waiting out Trump's tactics, gambling that internal US political or economic fallout will shift the balance. Meanwhile, the window for a stable trade resolution continues to narrow. As both sides hold firm, the cost of inaction on supply chains, market stability, and diplomatic credibility keeps rising. President Trump has broadened his trade focus beyond China, calling for a restructuring of trade imbalances with countries like India, South Korea, and Japan. This reflects a shift toward a more aggressive regional strategy, positioning the US to challenge multiple Asian partners over long-standing trade deficits and perceived unfair practices. However, internal disagreements within the administration are surfacing. While some advisors push for a hardline stance across all fronts, others warn that alienating allies could backfire economically and diplomatically. These divisions complicate policy execution. Mixed signals from Washington may erode US credibility in Asia and undermine efforts to build a coordinated front against larger economic threats like China. The broader concern, overextending the tariff strategy without a unified internal consensus, risks fracturing alliances and weakening America's position in a critical geopolitical region. TikTok is facing renewed scrutiny amid allegations that its platform promotes pro-China narratives and anti-American sentiment, compounding the Trump administration's communications challenges during an intensifying tech and propaganda clash. The accusations feed into broader fears that foreign-owned platforms are being weaponized to influence public perception and manipulate political discourse within democratic societies. For the White House, the situation is doubly problematic. Not only does it raise national security concerns, but it also threatens to weaken public support for US policies amid rising global skepticism.